Bismillahirrahmanirrahim. Welcome back to my channel. Today we will discuss the various financial ratios. But before the understanding of the term financial ratios, first we will discuss the concept of the ratios. This is basically the relationship of one item with another expressed in mathematical form. And when we use the word financial ratios, it means we are using the financial values. So it becomes the financial ratios. These are the various commonly used types of financial ratios, that is the liquidity ratios, turnover ratios, debt ratios, profitability ratios, and the market ratios. In my upcoming lecture, inshallah, I will discuss all of these five types of ratios. But in this lecture, I will explain the various names of the financial ratios and importance of these financial ratios. These are also called income statement ratios, because these ratios compare one flow item from the income statement to another flow item from the income statement. For example, profitability ratios. It means when we calculate the income statement ratios, we are taking both items, numerator and denominator, from the income statement. And its best example is the various profitability ratios like gross profit ratio, net profit margin ratio, etc. These are also called financial ratios, are also called balance sheet ratios when the numerator and denominator in each ratio comes directly from the balance sheet. We are only using the data from the balance sheet, then it will become a balance sheet ratio, that is the debt ratio. For example, we want to check the ratio of the debt and equity in our investment. So it will become the balance sheet ratio. And another important shape or form of the financial ratios are income statement by balance sheet ratios. Such ratios compare a flow income statement in the numerator to a stock balance sheet item in the denominator. For example, activity or turnover ratios. In such ratios, we are taking figure of numerator from the income statement and the figure of denominator from the balance sheet, like turnover of inventory, turnover of receivables. That's why these are considered as income statement and balance sheet ratios, because here we are taking figure from both sides of the financial statements. Now the question arises, why we are using the financial ratios. What is the importance, what is the significance of using these ratios? Or what are the beneficial points of these ratios? So we say when we want to show the relationship between two variables, the ratio analysis is generally very helpful, not in the field of business, but in every field, in every sector. This ratio analysis is commonly in the practice. Furthermore, if we are feeling some difficulty in the ratio, we will simply multiply with the 100 and get the figure in the percentage, which is self-explanatory. Furthermore, we make the comparison between performance of the two different departments of the company, so the ratio analysis gives us a very much clear picture. Furthermore, we can easily show the financial picture or financial position to the creditors, stockholders, customer, taxation authority. Furthermore, in the budget preparation, this ratio analysis is commonly used by the financial experts. Through Ratios, past and present financial position can be easily compared, and the creditors can take a decision whether they should extend the credit or reject the credit. Furthermore, the future trends can be suggested on the basis of the ratio analysis. That's why, according to financial analysts, this ratio analysis is very important and a simple technique to check the financial position of an organization. Inshallah, in my upcoming lecture, I will discuss all of these ratios one by one with the numerical calculation. I hope you will like it. Please share it and subscribe it. Thank you and Allah Hafiz.